$1.4 trillion. Gone. In a single session. Here's what's really going on. And what you should be thinking about right now. June 5, 2026. One jobs report just torched the entire market. The U.S. economy added far more jobs than anyone expected. Sounds like good news, right? It isn't. Not for your portfolio. Here's why. A red-hot labor market means inflation stays sticky. Sticky inflation means the Fed doesn't cut rates. And if the Fed doesn't cut, they might actually hike. That single realization wiped $1.4 trillion in S&P 500 market cap in one day. The Nasdaq dropped 4%. That's its worst single-day performance since April 2025. Chip stocks, cloud names, AI darlings, everything got torched. Bitcoin cracked below $60,000. When crypto sells off alongside equities, that's not a sector rotation. That's full risk off. Every asset class is flashing the same signal at the same time. And here's the gut punch. This sell-off just snapped the S&P 500's 9-week winning streak. 9 straight weeks of gains. Erased by one morning of economic data. But here's what nobody is saying about this yet. The mainstream narrative is blaming the jobs report. That's too simple. What really happened is that the market had priced in perfection. Multiple Fed cuts. A soft landing. Endless AI-driven earnings growth. Traders built a 9-week rally on assumptions. Today, one data point shattered all of them simultaneously. Bond yields spiked instantly. That crushes the valuation models underpinning every high multiple growth stock in your portfolio. When the risk-free rate rises, the math on future earnings gets brutal. Fast. This isn't just a bad day. This is the market repricing the entire rate environment. And that process rarely ends in a single session. 3 things worth considering right now. Education only, not advice. First, audit your tech exposure. If growth stocks represent more than 40% of your portfolio, today is the day to ask whether that concentration still makes sense in a higher for longer rate environment. Second, look at low volatility and dividend plays. Sectors like utilities, consumer staples, and dividend growers historically hold up better when rate expectations spike. They're not glamorous, but right now, boring beats broken. Third, don't dismiss cash. Money market funds are yielding real returns right now. If the Fed hikes instead of cutting, cash isn't a drag, it's a weapon. Dry powder lets you buy the dip when the real bottom arrives. $1.4 trillion erased in one session. A 9-week streak snapped. And the Fed pivot narrative is officially dead. The next move is a hike, not a cut. Agree or disagree? This video is for educational purposes only, not financial advice. Always consult a qualified advisor before making any investment decisions.